I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to make you some money. My job, not just to entertain you, but to educate and teach you, has been doing for how many years? This is our 16th. So call me at 1-800-713-CNBC or tweet me, please gently. It's our 16th, at Jim Cramer. So you're getting your stimulus check from the government, right? I mean, what do you do? What do you do with it? Before we even talk about investing, you got to plug some holes. Got to pay off your credit card debt. Maybe you got to make sure you got some health insurance. I know, really boring advice, but those costs can eat you alive. Once that's covered, you should put most of what's left into a cheap index fund that mirrors the S&P 500. That's for retirement. And then finally, there's your mad money, a fitting concept given that today is indeed our 16th anniversary. And otherwise, sedately positive session, Dow ultimately advancing 175 points. Oh, it traded all over the place, but then nicely, S&P gaining 0.65% and the Nasdaq climbing 1.05%. Well, you're probably thinking, why doesn't Cramer say start with individual stocks? Because if you qualify for a stimulus check, you might not have enough money for cushion. I always tell you to put your first 10 grand into an index fund because you start picking stocks or assets like cryptocurrencies. Well, you know what? I've been saying for a decade and a half, you got to be diversified. And that's what the pulpit's about. Be diversified. But let's say you got that cushion. What's next? All right, well, your choice of investments depends on where you are in life. And to a lesser extent, your own personality, which I can't tell you about. I mean, if you're young and you got a whole lifetime of paychecks ahead of you, you can afford to take on a lot more risk, assuming you're comfortable with it. As you get older, you do need to be more cautious. It's just what life's about. In the old days, I would tell you to pick the stock of a company you knew and liked and read the annual report, listen to the quarterly conference call, look up any relevant articles, and maybe do some buying if you like what you see. Very often, though, people would balk because the share price was too high, meaning it cost too many dollars, and because there are a lot of commissions. These days, there's no longer a problem because we got fractional trading. You can buy a tenth of something like Tesla or Amazon or Alphabet and no commissions. Now, the younger you are, the more I'm begging you to take an aggressive stance on something speculative. What does that mean? Let me give you textbook examples because we've got them all over the place. A year ago, Moderna was speculative. It was a relatively untested biotech company. Now we know they've had incredible success with their COVID vaccine. You know what? I don't believe their RNA technology extends beyond this one virus. Stocks had a huge run. You know what? I actually think you can still justify owning a piece of it up here because management has staked out a series of vaccination efforts that could lead to being multiple blockbusters. But how about if you're older? Well, then I think you got to switch gears. I think you got to try a stock like Johnson & Johnson. It's a company with a long track record of paying dividends, done some remarkable work with its own one-shot COVID vaccine, although not that it's necessarily a needle mover. J&J doesn't have the radical upside of something like Moderna. In fact, they're not even trying to make money on the vaccine. But the company has a tremendous history of doing right by its shareholders, managing its capital well, and developing new drugs. Oh, and by the way, and this matters for some people who are a little bit older, but not younger, it has the best balance sheet of any large company in the country. Now, you can see this kind of dichotomy at play in just about every industry. Today, we learned that a private company in the red-hot payment space, an outfit called Stripe, had a round of financing that valued the business at nearly $100 billion. I mean, enough. I know I got another $100 billion, but wait a second. What does that tell you about the space that Stripe's in, the payments industry? Well, to me, it means the future's very bright. So you might be drawn to Square, SQ, which has a Cash App platform, something that could grow for years and years, and is regarded as the easiest place to buy fractional Bitcoins. I am totally enamored of the stock of PayPal, Dan Schulman's company, which I see as the worldwide digital bank of the future. Speculative? Yes. But not nearly as much as it used to be. Now, but maybe you're drawn to a more mature payments play, a longer track record, something you heard of, something that's in your wallet. How about a Visa? How about a MasterCard? Maybe you prefer a slower grower with a solid history of dividend payments because you want income. JP Morgan. What else? We know the future belongs to the cloud, even if those stocks have fallen out of favor in the last couple of months. For younger investors, that means you should consider buying Snowflake. Yes, that ultra-fast growing data warehousing company that's crushing the numbers. And don't believe people said that last quarter wasn't any good. That's because those people don't know anything. I mean, that quarter was amazing. Now, if you're older, though, or a little more skittish, I do like Salesforce. I like Adobe. I like ServiceNow. If you're worried about staying power, you might be drawn to Microsoft, even as I would argue that Salesforce will give it a multi-year run for its money, and believe me, they're trying to. Sometimes a stock moves from one category to another. Last year, Tesla was the ultimate junior growth play, the classic high-risk, high-reward story with a huge payoff. Even after this huge run, I can't stop anyone from buying Tesla. I like it too much, despite Elon Musk's eccentricities, like his decision to crown himself a techno king in chief, which would be fine if he tweeted it, but he put it in an SEC filing, for heaven's sake. But here's what I will say. Tesla's no longer a junior growth stock. Oh, no. Now it is a senior growth stock because how big it is. If you're a younger investor who wants something higher risk, I want you to consider Churchill Capital 4. I know that's a mouthful, but it's the SPAC that's merging with Lucid Motors. Not a mouthful, but a really cool car. That could potentially be the next Tesla. Don't worry, Elon Musk does not watch, so he won't be mad at me. This thing imploded last month because the stock got too hot in anticipation of the deal. Not their fault. When I say it's high risk, though, I mean it. However, after that decline, I'm willing to endorse Churchill Capital 4 as long as you're young, because young people still have time to make back those losses if it doesn't work. Even though this thing already blew up, it's one of the rare SPACs that's a good operator and not too promotional, and is not at its high or near it. And if you're older, stay tuned, because the safest way to play the electric vehicles is Ford or GM. More on that later. How about today's biggest movers? There's AMC, the movie theater chain that's just now reopening 2 locations in California, and that was destroyed by the pandemic, that company. It was up 25% today. Then there's GameStop. Oh, that's that Wall Street Bets favorite. They love me. I've seen some fantastic things about me there. And that stock sank almost 17% after a big run last week. To me, these both feel like stocks that have moved too much. We've seen this movie before, and we know it's hard for these meme stocks to stay at such elevated levels. But I know both AMC and GameStop have some incredibly devoted shareholders, so I will say this. If you're drawn to this kind of trade, you need to think about suitability, like Lucid Motors. I mean, you got a much greater chance to lose money in a stock that's advanced tremendously on no real news, and younger investors have more leeway to lose money. In other words, and I'm not slighting them. I mean, that's part of the joy of being young. You callow youth. You can get away with trading meme stocks when you're 25, much harder when you're just when you're 65, 55. And when you're 65, meme stocks? I mean, I'm a meme, but I ain't a stock. Now, I'm just using the stimulus check example to drive home the point that you need to think about what kind of investor you might be. And for those of you who are too wealthy to qualify for a check, remember, please, you only need to get rich once. The bottom line, once you put enough money away in a cheap index fund, you can start thinking about your discretionary mad money portfolio. But before you start picking stocks, you need to figure out what level of risk you're comfortable with. Once you know that, you're likely to do much better in the long run. And that's what Mad Money's about.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.